This is one of the most volatile times we've seen since 2020 or even 2008. But if there's one thing that proves certain for sure, no matter what the circumstances are, is that the investor that stays calm and takes advantage of opportunities does far better than the investor who panics. The investors who panic and make emotional decisions almost always lose, and they end up making a lot less money even if the market recovers. So let's take a couple of minutes and actually look at the technical analysis from Tom Lee and what he thinks is a structural support in this market.
But there is some significance to the fact that the VIX was at 60 and now is at 31. Let me explain. There's three numbers I want to highlight.
All right, so we're going to go over three specific numbers of key support levels and technical bounces.
The VIX was at 60 on April 7th, and then on April 11th, the VIX closed at 37.56, which is an important level. And then earlier this week, it closed at below 31. The VIX above 60 has only happened a handful of times. It happened, of course, this past week. It happened during COVID, and it happened during the GFC.
Right, so VIX over 60 is basically COVID. That's 2020. And then 2008, the great financial crisis. That's when we saw VIX over 60. Recently, we've also seen VIX over 60, and now it's coming back down. So this is a very profitable key trend that has been proven throughout history.
Well, let's look at the GFC. Let's use those three dates or those three levels I marked. The VIX above 60, which was October 2008. The VIX falling below 37.56, which didn't happen until January 09. And the VIX closing below 31. Well, importantly, when you close below 31, you were past the low because the low was March 09.
In the same exact situation. This is why studying history is very important because history repeats itself.
During COVID, the VIX didn't close below 37.56 until March 24th, 2020, and it didn't close below 31 until April 2020, but you were already past the low. That's why I think it's important to consider that some important structural low took place this past week. So I think that we're still in a bull market. I'm just not clear if it's a V-shaped recovery like 2020 or it's a range market like 2011. Intuitively, I'm going to say that it makes sense that we made a bottom, but we may be range bound for a bit.
This is actually the best opportunity if the market is going to be range bound to sell put options, exactly what I showed in my yesterday video about Palantir. It's the exact strategies that I'm using in my portfolio right now. I sold puts on Palantir, sold puts on Nvidia. I'm looking at buying Apple stock right now. I'm looking at buying companies, but instead of just buying into them, I'm selling put options, which supports exactly what Tom Lee is saying. If we're going to go sideways and we get zero returns for the next 3 weeks, 3 months, then the best opportunity will be to still create income and to purchase companies as they are going back up, as they have this recovery that's not going to be V-shaped.
And that's because people are worried that there's other shoes to drop. I mean, the tariff war with China could turn into a Cold War. Investors are going to worry about the ripple effects from this shock leading to a global recession. These are extreme views, by the way. That some people are going to worry about a financial crisis from all this deleveraging. And inflation expectations could surge to an extent that we get greedflation. Remember, that's like companies basically raising prices, and it's going to force the Fed to hike. And of course, if estimates fall more than 20%, stocks have downside because the stock market already had a 20% drawdown. But the internal low seems to have been in place. This is the percentage of stocks above the 50-day moving average at the top and above the 200-day moving average on the bottom. Below 20% is a big deal because over the last 16 years, the S&P was higher 6 months and 12 months later. In fact, if you look at 3 months later, outside of 2022, the stock market was higher 3 months later every single time. So I think we did make a structural low.
So guys, what's really interesting is when there's a lot of fear in the market and the VIX is over 60, and that's basically what we saw in October of 2008. And then a couple of months later in January of 2009, basically we had the bottom. And then when things were recovering in May 2009, then basically the market was past its low, as Tom Lee was saying. And we're in a very similar market right now. It looks exactly the same. There's a lot of fears in the market. There's a huge sell-off, and basically everyone got out of their stocks, but we've already seemed to have hit that low. So a lot of people have lost money. Many investors have gotten out of the market, have quit investing, have given up on option trading, have given up on long-term investing, short-term investing. They're out. They're done. And now that we're getting a recovery, the investors that have been holding, the investors that have been subscribed and seeing some of my videos about, what stocks I'm buying, then you have started to recover your money. And my portfolio has started to recover a lot. And from here on in, I really think that we're going to get two scenarios. One, like Tom Lee said, basically a sideways market. And this is because there are still concerns over tariffs. There are still concerns about recessions. And after you have a lot of pain in the market and you lose money, everyone's not going to just jump back in willy-nilly, right? Now we're more cautious. So we're going to get a slower recovery, unlikely to have a V-shaped recovery because we already had so many V-shaped recoveries since 2020. Of course, they were mini recoveries, but right now I think investors are going to be more cautious. And it's really important to directly compare this to the VIX and to 2008 crisis because there's a lot that we can learn here. The VIX was at 60 before the market fully crashed and hit a low. Then after the low, the VIX settled down around 30, marking the passing of the market's low. So what does this mean for the market crash happening right now? If they're already at 60 and now it's back down to 30, it means right now is essentially the urgent time that you should be taking action. There should be no more waiting and guessing because when we get a recovery, it's going to be kind of too late because now we're buying in stocks that are a lot more expensive than when they have sold off. Obviously, nothing is guaranteed and I can't predict the future. And Tom Lee said that the only way he could see the market going, lower and crashing even further is if we go into a Cold War. And there is a non-0% chance of that potentially happening. Now here's another screenshot from Dan Ives. This is what he said on X or Twitter. He said this 3 days ago on April 17th, 8:43 in the morning. Got a good amount of views at 47,000. So a lot of investors following what he's saying. And this actually has a big impact on the market. But here's what he said. He says Trump's White House knows that one chip is fueling the AI revolution, and it's NVIDIA. And essentially, put a do not enter sign in front of China for NVIDIA and Jensen, as well as AMD/semis with this reaction. Important and latest punch thrown in the tariff boxing match. Now, when it comes to Donald Trump's still on his way to enforcing tariffs, to making sure that America gets its, cut, what he says is fair cut. And this is what Donald Trump also tweeted out. He said, had a very productive call with the president of Mexico yesterday. Likewise, I met the highest level Japanese trade representatives. It was a very productive meeting. Every nation, including China, wants to meet. Today, Italy. So look, in terms of volatility, it's probably going to continue in terms of the market experiencing volatility. However, again, what I see happening is the VIX has finally settled down. This is a sign that investors finally realize that, hey, there was a lot of concerns, but the market presented a lot of opportunities. The market went, way cheaper. The price to earnings ratio on the S&P 500 is a lot more reasonable now. And we have nowhere to go. If you're an investor, what do you do with your money? Do you have a lot of cash? Not really, right? Because there's still a lot of inflation going on in the market. Do you put it in real estate? Well, not everyone wants to buy a house. Not everyone wants to own multifamily condos. Not everyone wants to own, apartment buildings. So the only other place is really bonds, but bonds are very slow growing. So the stock market is really the only investment tool that actually builds long-term wealth that doesn't take that much work. So since cash isn't the answer, bonds are not the answer, real estate's not the answer, we only have one game in town. And yes, we can try timing the market, which is incredibly difficult. Trying to time the market is basically like trying to make the perfect cake and baking it, and you're a complete beginner. You don't even know how to bake a cake, okay? You're just probably not going to get the timing right. So instead, take advantage of the market by selling put options, aiming for 30 delta. You can also aim for 20 delta if you want to be very conservative right now, or if you're more of a risk taker, then go for a 40 delta option where you can have a higher chance of getting assigned. I covered this yesterday in my Palantir video. I'm going to remind you of that video on the screen right now because it's the perfect formula of what you should be doing right now in this market.